You're listening to the Final Say Radio Show, a Rappaport Media production, with your host Brett Rappaport and co-host John Rappaport.
Joseph Lawler is another expert. He's an economist, covers issues of economics with the Washington Examiner, and he's a return guest to the Final Say. So, Joe, it's a pleasure to have you back on. Thank you so much. And
thanks for having me on.
Sure. I'm glad that you've written this because I was having the same thoughts as I saw the reporting that they wanted to stir up some lending again and that they were going to ease some things here. And, my first thought, on one end, you really want markets to kind of drive themselves, because I'm always afraid when the government's taking actions that drive a market, because it's kind of unnatural and it usually leads to bigger problems. But the question is, will this really help? And are we going to go back to what got us in trouble in the first place? So there are a lot of different angles to look at this, but of course you wrote the piece, so I'll let you add your 2 cents.
Sure. When I wrote the piece, what I was hearing from bankers and others is that the latest rules won't do much because the problems in our housing market go so deep that they can't be addressed by any one rule or any one fix coming out of Washington, D.C. There's a whole set of factors here that helped create the financial crisis and haven't been addressed since. So I wouldn't expect too much from what has gone on in D.C. this week. And just to clarify what that was, is it's a new rule that was approved by 6 different agencies, setting out the standard for what is considered a safe mortgage that lenders don't have to keep a stake in to ensure it doesn't blow up when they offload it to an investor. And that's one piece of the regulatory structure that's been put in place as part of Dodd-Frank.
Yeah. Now, you see, it's an interesting thing because I've spoken to a lot of people over the last, I'm going to say 5 or 6 years, on this particular issue. Mm-hmm. And, people giving me, some background on some of the loans they've tried to get and difficulties they've had. In some cases where, people who are making a significant amount of money, but maybe they went through a divorce or whatever, and maybe for whatever reason their credit wasn't good, but they actually went in and said, I want to buy, say, a $500,000 home. I'm putting $200,000 down. You would think it would be easy to get a $300,000 loan for somebody who's making $300,000-$400,000 a year, and they're getting denied. But then you see reports over the last few years of people who can't even prove they have income getting loans. So you wonder, are all agencies or are all people subject to the same guidelines and restrictions, or is this depending on what your situation is?
Yeah, it absolutely varies from person to person. The great example that we had just a few weeks ago, I'm sure you remember this one, is that former Federal Reserve Chairman Ben Bernanke himself was turned down for a loan, and he's a guy who can earn $250,000 just by giving a speech. So, it depends on your circumstances, and sometimes for some people, if they can get a loan that will be backstopped by the FHA, even though they are low income, getting access to credit might be easier than someone like who you just described, who's well qualified, but for one reason or another doesn't fit into the box. One of the boxes that have been set up for who can qualify.
Right. Now, there's another interesting story. I knew a fellow who, he lost his job and he couldn't pay his mortgage anymore. Yet his wife is still working, and they actually lived in a home for the better part of 3 years without making a single mortgage payment before they were in foreclosure, but I guess the paperwork got lost, or one of those issues. Mm-hmm. But actually lived there for 3 years before they had to leave. And I think it goes to a bigger problem. And as you've pointed out, a lot of the experts in the industry themselves say some of these changes aren't going to help. But it's almost like a mindset within this country. It's within government, it's within corporations, it's within the individuals, that we forgot the proper way about going about managing your financial life. And that's a big open statement. But it just seems to me that there's a lot of irresponsibility on all ends, and for us to ever really solve this particular issue, it's not just attacking the banks. It's not just attacking the borrowers. It's really looking at every component, from government to lenders to the borrowers to the agents, the real estate agents, anyone in between, ensuring that people are, sometimes people don't meet every specific qualification, but they still can qualify that they could pay a mortgage. And then sometimes we have to say no to somebody that just can't.
Mhm. Yeah.
And I'm sorry, one last thing. The other thing is that you also have to properly, in lending markets, to keep your economy stable and growing. Because if you tighten too much or you open it too much, we saw what happens when you open it too much, and then we saw on the opposite, when you tighten it too much, you keep growth from happening.
Right, yeah, and I think those are good points. And right now, in the wake of the housing crisis, I think they're trying to find a balance there. They do not want to, everyone realizes this, from the Obama administration to the people in the industry, no one wants a repeat. No one wants to see the same kind of crazy, no documentation loans that were made that later blew up and brought the economy down. On the other hand, right now, credit remains tighter than it was even before the housing bubble got started. Based on, you can look at the credit scores for loans that are made, you can look at the number of delinquencies, and they indicate that right now credit is really tight, and that, as you said, you want credit flowing. You want people who have the ability to repay a mortgage and can own a home and not be a risk to the bank and to the broader economy. You want them to get that loan, and right now it seems that there are a lot of people out there who aren't. But as you said, there's kind of a culture of dysfunction where private insurers, private investors don't really trust the banks, who in turn don't really have a personal connection with a lot of the customers that come to them looking for loans. And so there's a lot of things that could be done in a different environment, in a better environment, that aren't getting done right now.
Joe, it seems like this is an area where you have a clash between excessive government policy and, some would argue, too much, some would argue too little government regulation. I'll give you an example. It was very clear that some of the folks like Barney Frank, who, the former congressman of Massachusetts, who was one of the most vocal proponents and of these social engineering projects to make it very, not only very easy, but actually was seeking to punish banks who weren't giving loans to minorities and others who under normal lending practices wouldn't qualify under the guise that this was racist policies and so forth, and then at the same time then turned around and tried to make it look like evil, rich Republican bankers were the cause of all of this. So how much would you say of the problems that we bear, how would you define it between, let's say, individual responsibility, poor government policy, and either too much or too little regulation?
It's tough to assign blame. I don't know that anyone was really innocent. I think it comes down to that's a tough one to address. I think that speaking to people in the industry, there's definitely a fear that you're damned if you do and damned if you don't, right? Where if they make loans, then somewhere down the line, if those loans go bad on someone that once they've sold them off, they'll get sued for them, as the government has sued all of these banks for many billions of dollars. But then they also fear that if they don't make the loans, they'll be setting themselves up for some kind of litigation based on discriminatory lending. So that is definitely one factor that is at play right now.
Now, it seems to me that the individuals themselves still bear a lot of responsibility here, and that the more government bails people out, the less likely people are to make good business decisions, because I know personally an amazing number of people who really have no specific idea how long they'll live in an area or in a given house, but, for example, will always go for the lowest interest rate loan, even with very short term loans, but understand that the minute interest rates turn around and flip up, as they did when I bought my first house in '87, I had neighbors who literally, I saw grown men crying because within a couple of short years, their interest rates shot up over 4, 5, or 6%, and they couldn't make. They were going underwater, and the price of their house was coming down. And this was back in around the 1989 range. And it seems to me that that's also a big issue. Is when we bail people out or just try to make the banks guilty, we forget that these are still people making decisions. I don't buy a $120,000 car if all I can afford is a $40,000 one. To me, that's kind of simple math and my responsibility.
Yeah, and the individuals are certainly party to what happened, and they will be when the next time some kind of crisis like this comes down the road, they will be they'll be just as culpable as anyone. And this is an issue that keeps coming up when the Congress tries to work through what an alternative to the current dysfunctional system might look like. And the question of when the government is going to step in with a bailout is one that it's unavoidable. And for just as an example, the bill that the House Republicans tried to advance last year to replace Fannie Mae and Freddie Mac with a housing finance system that included no government guarantees was opposed even by a lot of conservatives who, or I don't know how you call them conservatives, but certainly people on the Republican side of the aisle who would say, if mortgage-backed securities go bad in the future, there's going to be a government bailout by some future Congress or some future president. We can't prevent them. We should have the infrastructure in place to deal with it when they do. So that tension between the individual responsibility and the possible expectations of bailout, it's always going to be there for the borrower and for the lender and for the investor.
One of the things that I heard a lot of negative predictions about was that there was a commercial bubble coming because the same exact issue we had in the residential mortgage fiasco that really manifested itself in 2008 was within a couple of years going to hit in the commercial real estate market. And if you look at even certain categories or classifications of stores, take Blockbuster for an example, right? 5 years ago, there was a Blockbuster in every corner. Well, that then turned into a 10-square-foot amount of space in your local supermarket with a red box, and now almost entirely online digital. So It seems to me that there might be some legitimate concern there. Is that a bubble that you see still expecting to burst, or is the commercial somehow found a way to immunize itself to the issues that we've seen in the residential real estate lending market?
That's a really good question. I know it was controversial even after the 2008 crisis whether there was a bubble in commercial real estate to the extent that there was in the private housing market. I don't know right now. I think it's certainly something to keep a track of. None of the regulators who look at that kind of thing have blown the whistle on that yet, and they, I think, right now are certainly prejudiced to be more worried about such things than less. But I also think that a big part of this is going to be huge geographical variation, right? Where you might see it in some parts of the country, like New York City or San Francisco or Miami, or across the Midwest or other places, they're way behind in terms of price gains. So I that's a good question. I think it's something that we should be paying close attention to in the next few years. Right now, not clear where that's headed.
Joe, I have a question for you, and this is more of a Fed question. And I love listening to Larry Kudlow. Every Saturday when he does his radio show, I try to tune in and listen to him. He has great guests from all different parts of the financial world. And this weekend he had the Dallas Fed representative, Richard Fisher, on, who I believe is retiring soon. And, they had an interesting discussion. They were talking about Janet Yellen. And it was interesting to me because Dr. Fisher was actually pretty complimentary of Janet Yellen and the work that she's done since taking over. And I was just curious of your opinion on how she has done so far, because it seems to me that I might not have agreed with a lot of things she had done prior, or kind of where she comes from in the School of Economics, but she does seem to be, cutting back the amount of printing that we're doing. I guess eventually will be mass amount that we've been buying back of the mortgages and things like that are being reduced as well. But I guess the biggest complaint I'd have is the fact that I think it's very dangerous to continue to have 0% interest rates. But what are your thoughts on what she's doing, how she's doing, and how that would impact the housing market that we started the discussion with?
I think the thing to realize about Janet Yellen is that she is very much someone she's a consensus builder, and she's someone right in the mainstream of economics and Federal Reserve, their views on economics. She's not one to be out to the extreme on either end of a discussion about monetary policy, whether that's quantitative easing and bond buying or raising rates. She's going to be right there usually toward the center of the pack. And to that extent, I would actually say she's pretty close to being in the mold of her predecessor, Ben Bernanke. And, she was his vice chair while he was chair, so she was helping him formulate a lot of these policies like quantitative easing. And as far as the future goes, she said, and people like not only Richard Fisher, but John Taylor, the Republican-aligned monetary economist at Stanford, they've said she wants to get back to a period of normal monetary policy where the Fed uses interest rates as its policy tool and not quantitative easing or anything else. She wants to get back there as soon as possible. But she's also someone who, when there's a big downturn and she thinks the times are required for it, will, like Bernanke, take whatever measures she thinks is appropriate. So she was certainly a big advocate and proponent of quantitative easing, and now she's going to be just as serious about getting back to normal.
So she's actually sort of in favor of a Taylor rule.
Yeah, she said that this has come up time and time again when she's been questioned by Republicans in Congress, and she said, I look at a number of rules, I consult them, I'm in favor of things like that, but when something comes along along the magnitude of what the financial crisis was, then it might be necessary to go beyond the rules the way that they did.
That's interesting to know, and thank you for that information, because we certainly got on Bernanke's case quite a bit, but we don't have as much experience with Janet Yellen, but also it's different times now. She's coming in after all the chaos, and now she's got to figure out how to keep us from slipping into a recession, or how to keep that whatever growth we do have, keep that I guess puddling along, if you will.
Right.
Anyway, it's very interesting. I'm sure we can go on. There's many other issues all day long, but Joe, last question I have for you before we let you go today, and of course we thank you for spending so much time with us. Do you have a general idea of when do you think the housing market will be in, maybe not a full recovery, but in an area where you could say it's one of the stronger parts of our economy and something that could be relied upon for future growth?
You know what? I think that's one of the questions. If I had a good answer to it, I would be making investments on Wall Street and not doing journalism. But I think that it's fair to say it's a long ways away, because we're not. If you look at the numbers in terms of new houses sold, existing houses that are being sold by their owners, we're not close to where we were, not just during the bubble years. No, we don't know if we want to go back to those levels, but the pre-bubble years. So I think that it's at least it's in the years away, and you look at the demographics of the country are changing, and that's one huge factor. So we don't know, if they'll ever get back to those numbers, really.
Yeah, that's an excellent point. And anyway, Joe, thank you so much. We really appreciate it. And of course, we are speaking with Joe Lawler, who's with the Washington Examiner. And Joe, I don't have it right in front of me, but I know you have a Twitter handle as well. if you could please share that with our listening audience. And, of course, if you want to find out more from the Washington Examiner and specifically some of the pieces that Joe's been working on, you can find Joseph Lawler on WashingtonExaminer.com. And your Twitter handle, please?
It's just my first and last name, Joseph Lawler.
Excellent. Again, thank you so much for joining us. We really appreciate when you come on the program, and we look forward to having you again soon.
All right, thank you very much.
Okay, take care. Again, thank you.